Look, I need to tell you about something that just happened in the semiconductor space that should terrify every retail investor right now. Thousands of people woke up one morning thinking they'd made fortune overnight on a stock called Wolfspeed. By noon, they owed their brokers money instead. And no, this wasn't a hack or a scam. This was a textbook example of what happens when you confuse a good story with a good investment. Okay, real quick, if you're short on time, or if you're thinking, why should I listen to some random guy on the internet? Here's the single most important thing you need to walk away with today. When a company files for bankruptcy, your shares don't just go down, they get erased, completely wiped out. And all those social media posts screaming buy the dip or short squeeze incoming, they're not your friends. They're noise that can cost you everything. Now, if you want to understand exactly how this happened and how to protect yourself, stick around because this story gets wild. Hey everyone, I'm DataCat. For those of you who are new here, welcome. This channel's only about 2 months old, so we're all kind of figuring this out together. A bit about me. I used to work as an analyst inside a Fortune 50 company. You know, the whole corporate thing, spreadsheet stand-up meetings, the occasional existential crisis in a beige cubicle. Eventually, I decided to trade that life for, well, this. Lasers, keyboards, and talking to you folks about markets and investing. I'm not here to brag or pretend I have all the answers. Honestly, putting myself out here is a bit uncomfortable. But I figured if I spent years analyzing data for executives who barely read my reports and could just get rid of me whenever they feel like to, maybe I could share some of that with people who actually care. So yeah, that's me. If you find this stuff useful, please do me a favor. Hit that subscribe button and the bell icon. It genuinely helps a small channel like mine reach more people. Alright, let's get into this Wolfspeed disaster. So, first things first, what even is Wolfspeed? Wolfspeed is an American semiconductor company based in North Carolina. They make silicon carbide chips, SiC for short. Now, I'm no engineer, but if you're not familiar with silicon carbide, think of it this way. Regular silicon is like your standard house cat. Does the job, mostly reliable. Silicon carbide is like a tiger, way more powerful, handles extreme conditions, doesn't melt under pressure. It's the material you want for high-power applications like electric vehicles, solar panels, data centers, and 5G infrastructure. The technology itself, it's actually quite common and legit nowadays. Silicon carbide should be superior for certain applications. The problem, and this is where the story gets interesting, is that having great technology doesn't automatically mean you have a great business. Let's travel back to 2020 and 2021. Wolfspeed became the poster child for the AI and EV revolution narrative. Investors were pouring money into anything remotely connected to electric vehicles or artificial intelligence. The logic seemed bulletproof. EVs need power chips, AI data centers need power chips, Wolfspeed makes those chips. Boom! A gold mine, right? The stock soared to an all-time high of around $141 in November 2021. Social media, especially investment forums like Reddit and X, amplified this excitement. Retail investors saw Wolfspeed as a pick and shovel play. But here's the twist about this hype, it doesn't pay the bills. And Wolfspeed had a lot of bills. The company borrowed heavily to build the so-called state-of-the-art factories. We're talking about a $1 billion facility in New York alone. By 2025, Wolfspeed was carrying approximately $6.5 billion in debt. $6.5 billion. To put in perspective, its entire market cap was less than $1 billion already back in 2024. Now, just to be clear, for a growth company, debt isn't inherently bad if you're generating revenue to service it. But Wolfspeed new factories struggled with yields. It means the percentage of chips that come out working properly. And the industry standard is around 70%, while Wolfspeed was hitting below 30%. Imagine running a bakery where 7 out of 10 loaves come out burnt. You're burning cash, literally and figuratively, without generating enough revenue to cover costs. On top of that, EV market didn't explode as fast as everyone predicted. Demand softened, and to make matters worse, Wolfspeed had been counting on $750 million in CHIPS Act funding from the government. Policy shifts happened, and that money never came through. So you've got massive debt, low production efficiency, softening demand, and no government bailout. Cats are supposed to land on their feet, but Wolfspeed was in a free fall. By June 2025, the company filed for Chapter 11 bankruptcy. And this is where it gets really frustrating. Throughout 2024 and earlier this year, while the company was clearly heading toward bankruptcy, social media was still screaming a buy. In early May this year, Wolfspeed saw a 52% increase in Reddit mentions. The stock jumped 24% in 1 week. People were posting about insider buying. They pointed to high short interest. Over 41% of the float was shorted. The narrative was, this is the next GameStop, short squeeze incoming, get in now. But if you actually looked at the fundamentals, and I mean really looked, the picture was horrifying. The company was reporting negative shareholders' equity. They had less than 1 year of cash runway. They posted a net loss of over $200 million on declining revenues. They were facing goodwill impairment charges. As you should be able to tell by now, this is the danger of narrative-driven investing. On one hand, a YouTube video or social post might sell you a compelling story. AI needs chips. Wolfspeed makes chips, therefore Wolfspeed wins. But on the other, the reality was, Wolfspeed can't make chips profitably, is drowning in debt, and is running out of time. Volume of discussion does not equal quality of analysis. And this is something I really want you to internalize. Just because a stock is trending on social media or someone's talking about it, even including myself, doesn't mean it's a good investment. Sometimes, oftentimes actually, it means you're watching a slow-motion car crash. Alright, so Wolfspeed files for bankruptcy in June, but the entire fiasco didn't just end here. Fast forward to Monday, September 29th. The company emerges from bankruptcy with a restructuring plan. They reduced debt by 70% from $6.5 billion down to $2 billion. Sounds great, right? At least social media and diamond hands were right once again. Well, here's the catch. They cancelled all existing shares. Every single one. And they issued new shares at a brutal exchange ratio. Roughly 1 new share for every 120 old shares. Let me put that in perspective. If you owned 1,200 shares worth around $1.20 each before bankruptcy, you now own 10 shares worth around $25 each. 10 shares in total now worth around $250? Your holdings just became worth less than 20% of what they were before. But the drama didn't stop. Some brokerages didn't immediately adjust their systems for this reverse split and share cancellation. So investors logged into their accounts and saw something insane. They still showed the old number of shares, 1,200 shares, but at the new post-bankruptcy stock price, which had skyrocketed to around $22 to $32. Do the math. 1,200 shares at $25 each equals $30,000. People thought they'd just made a fortune overnight. Some of them sold immediately, thinking they'd hit the jackpot. Then the nightmare begins. They didn't actually own 1,200 new shares. They owned 10. When they sold what they thought they owned, they were actually short-selling shares they didn't have. When the brokerage systems corrected themselves, and they did, eventually, these investors found themselves short the stock at a high price, facing margin calls to cover the position, and potentially owing their broker significant money. And don't even get me started with those involved in options trading. The matter is simply chaotic and disastrous. Imagine going to bed thinking you're up $30,000 and waking owing your broker 5 figures. That's not hypothetical. It actually happened to some people this week in a matter of hours. So what do we learn from this absolute disaster? Lesson 1. Hype does not equal fundamentals. Social media excitement about AI and EVs couldn't save a company drowning in debt with serious operational problems. Separate the industry thesis, AI will grow, from the company thesis, this specific company will profit from AI growth. Those are not the same thing. Lesson 2. Bankruptcy wipes out shareholders. When a company restructures, existing shareholders almost always get destroyed. Creditors get paid first. You get whatever's left, which is usually nothing. If you're holding a stock that's heading toward bankruptcy, hoping for a turnaround, you're not investing, you're gambling. Lesson 3. Reverse splits are a red flag. They're usually a sign of desperation, not recovery. If a company you own announces a reverse split, that's your cue to do serious due diligence, or just get out. Lesson 4. Trust but verify. Always double-check your brokerage statements, especially during corporate actions like splits or bankruptcies. If something looks too good to be true, like a sudden 1700% gain overnight, it probably is. Don't make impulsive decisions based on account balances during transition periods. Lesson 5, and this is the big one. Yeah, there might be an AI bubble. Wolfspeed's story shows how easy it is to confuse a good story with a good investment. A lot of AI-adjacent companies are trading on hype right now. If they can't execute operationally, if they can't actually turn that hype into revenue and profit, they're going to face the same fate as Wolfspeed. But just to be clear, I'm not saying the AI bubble is popping tomorrow. Maybe it doesn't pop for years. But when it does, a lot of retail investors are going to get hurt. And the ones who get hurt the worst are going to be the ones who confused social media sentiment with actual analysis. Look, I know this video is different from my usual content. Normally I'm talking about stocks to watch, macro trends, technical analysis, that kind of thing. But I think case studies like this are just as important, maybe more so. Because this isn't ancient history, this is happening right now. And it's going to happen again to other companies if people don't learn to separate signal from noise. And also the exact reason why I've been trying to cover every angle, from fundamentals to technicals of a company, to ensure we'd make responsible decisions. So if you found this story useful or even just interesting, please hit that like button and subscribe. Share this with someone who needs to hear it. Leave a comment if you've got thoughts or questions. I'm still figuring out this whole YouTube thing. I hope I'm here to provide value, not just chase views. Stay sharp and stay safe out there. Do your homework. And remember, even cats have limits on how many lives they get. Don't waste yours chasing hype. Alright, DataCat out. I'll see you in the next one.